in the 80s, land and breeding livestock values. That's doggone nearly 25 years ago, maybe. But that's when President Reagan was in administration, and he tried to control inflation and the monetary value, and that's when farmers and business people did not have fixed rate interest rates on their loans. And that's the time period when the interest rate inflation was in the high teens and maybe even 20%. So therefore, we had a lot of money borrowed on a flexible interest rate loan, and interest rates went from maybe 8%, which was fairly common before that time period, to the high teens and 20% interest rates on borrowed money. So therefore, all the profit that was made during those time period went to pay interest on the loan. And that caused the value of land and breeding livestock to decrease because the profit wasn't there to pay the principal, to pay for family living. The profit used to pay the interest rates on the loans. So therefore, the value of the assets decreased because the profit potential was not there. And when the value of the asset decreases, then your financial ratios dip from the solid ground of 60% ownership and 40% bank ownership to maybe the reverse of that, where the bank would own 60% of the asset and you as the operator would own 40%. And that's when banks had to make the decision of liquidating the operators or selling out. So that's kind of a little bit explanation in detail of what happened in the 80s. So what's happened since then is those people who were fortunate enough to buy land in the 80s at $300 and $400 an acre have watched that land increase in value, be $3,000 and $4,000 an acre on good tillable crop ground today. And they're using that equity then to purchase more land or increase their assets. If you were fortunate enough to buy land during that time period, you've seen and experienced that on your balance sheets and on your financial and your operating dollars. You made some wise decisions. What we're seeing now is we're seeing some of those people that made that decision, they are selling land and using that money, that equity that they gained in that land or that asset, in buying better land, land that's closer to home, and selling off less desirable land, land better for wildlife and hunting, and using that money to, as I said, purchase better farm ground, more productive farm ground, or ground that's closer to their main farm site or farm. So hopefully that explains that a little bit. All right. If we go to the document camera here, we're going to move on to our next material, and then we're going to have a kind of a wrap up on the financial portion, and then a little bit of fun stuff to do. Okay? We're working now with this Form 2038, which is Session 2, page 14. And the term of is our farm business plan worksheet, but it's our projected / actual income and expense for this coming year. It's a projection of what's going to happen. So we got Joe here who's running that sample farm again. And this is for the time period of January 1 of 12 to December 31 of 2012. So you need to fill that in. Alrighty. So therefore, let it be known that this is what we're planning on doing. Okay, I'll get that as large as I can. We're going to plan on raising 200 acres of corn. And our estimated yield for this 2012 growing crop is 125 bushels an acre. And we farm all ground. In other words, we own the ground. We do not have any rented ground. And letter 1F, what portion of that are we going to feed? We're going to feed 30% of it. So therefore, we got saleable on 1J. We can sell 17,500 bushel. This is our projection. And again, we're using FSA $5 a bushel. So that's $87,500 that we plan on generating from our 200 acres of corn. Again, we're projecting the 2012 year and what we plan on doing. For some reason in my example, must have a wild imagination. We're going to plant 300 acres of soybeans. Must be my management ability because it's strictly a crop rotation issue. It's not financial. Because we all know corn is out producing soybeans financially on a per acre basis. I estimate a 35 bushel yield, and that's all being going to be sold and unused for the farm. So therefore, that produces a 10,500 bushels of soybeans. Projected selling price of $10.50. I plan on generating dollars of $110,250. I must have another wild imagination. I got 200 acres of winter wheat. At 50 bushel an acre. I'm not going to feed any of it, so therefore it's all for sale. So that's going to generate 10,000 bushels of winter wheat at $5.75. So therefore, I plan on generating dollar value for my winter wheat, $57,500. I'm going to hit the home run. I'm going to raise some alfalfa. I got 100 acres, 4 tons to the acre. All of it's mine under that one. I'm going to feed 50% and sell 50%. So therefore, I got 200 ton of alfalfa to sell. We're going to project that to sell for $90 a ton. And that's going to generate $1,000. Okay? All right. We got something called some steers we're going to plan on selling. Okay? So therefore, we got 50 steers that we raised, and now we're going to sell them a few months down the road, and we think they're going to weigh 750 pounds at $1.25 a pound, and that's going to generate $46,875. As you can see, our value per unit of grain and livestock is conservative. The old story here now, I'd rather be conservative with my income and a little bit long with my expenses on paper, so that when reality comes in, I got a little bit of a slide or leeway in case something doesn't happen. desirable to our business here. I have some heifers that I raised. 40 of those characters, a weight of 675, a value of $1.25 a pound, and that's going to generate $33,750. I plan on selling a few cull cows. We do sell cows, you know, they don't just go to the bone pile. 5 cows I plan on selling, and they're going to weigh $12.50 each, 70 cents a pound, and I plan on generating $4,375 in cull cows. Oh my goodness, that's the end of that page. Okay? So therefore, let it be known that we're going to move on to page 15. Okay? We're going to work with a little bit of something called other income, or whatever we call it. Again, we're on the form FSA 2038, and this is projecting our income and expenses for 2012. I got some ag program payments, direct payments of $5,000. And then I plan on doing some custom work, and in this case it's some baling of $11,750. I put in some crop insurance monies of $5,000 just to make a nice round number. If I add up my grain, my livestock, government payment, crop insurance, custom baling, I'm projecting that I'm going to generate $380,000 of income from the farm. Okay? Now we need to spend a little bit of time filling out the expense side that we plan on, and I'm going to do this and this. I could give you a total, but I can't. I got to do it line by line. So our car and truck expense, line 11, of $15,000. Our chemicals of $10,000. Line 13 is conservation of $4,000. Custom hire of $10,000. Need to buy some feed. I'm going to budget $19,000 for that. Fertilizer and lime, $40,000. Freight and trucking, $6,000. Some gas and fuel and oil of $20,000. Insurance of $8,000. Line 21 is labor hire of $10,000. Okay. Now we're going to work with the right-hand side of that, and we got repairs and maintenance. Here we go. $15,000 of repairs and maintenance. Seed and plants, $25,000. The good old supplies, $8,000. Taxes and real estate, $18,000. Utilities of $12,000. Veterinary breeding and medicine of $3,000. And then line 30 is other expenses of $10,000. And I want you to add under other the feeder cattle or feeder pigs that you purchase. My sample farm, I do not purchase any. But over the years we've taught this course, and one or two times somebody come in with just astronomical numbers. And the reason was, under FSA forms, there's no specific line where you put in the purchase of the cattle or hogs that you purchase and feed and resell. Okay. A very key one is line 32, interest. My number that I project to pay for interest is $28,000. So therefore, line 33, total expenses $261,000, and excuse me, I will raise that for you. Okay? Line 33, total expenses $261,000. There's two numbers that you have to have correct in our sample farm under the expense section. One is this interest of $28,000. The other is the total expenses of $261,000. Okay, line 34 then, and I'm going to go owner's withdrawal, or what's called family living expense, $30,000. Now here's a major point of discussion, all right? Everybody. This average farm spent $52,000 of family living cost. Remember, we shot that from the annual report. But on my FSA form, I say that the farm is going to provide $30,000 of family living cost. So the difference has to come from off farm. Spouse working off farm, whatever, I don't know, but you understand now, this is the family living cost in our financial statements that the farm is going to provide to the family. That has also been a point of question over the years. Why is there a difference between what I am projecting the family living costs from the farm to be versus what the actual family living costs are? Okay, we got some capital sales then. We plan on selling something for $8,000. And we have some, on line 36, on the right side of that, some non-farm income of $25,000. And then some capital expenditures. We're going to just budget of dollars we're going to go out and spend. With the Mitchell Group then, I want to do a quick review of the important numbers on this Form 2038. Line 10. We project to have income of $380,000 this 2012 year. Okay? The next important number is line 32, is this dollar value of interest. We plan on paying $28,000 of interest. And line 33 is the total expenses of $261,000. Those are the important numbers. You need to have those. Okay? Questions? Thank you. We're going to finish up the last portion of this, and then we're going to do some doggone fun stuff. Okay? Some cash flow stuff, and that is session 2, page 16. Some cash flow stuff. We got to go back to a little bit of concept. Flow, what are called projections. All right. And then we have what's called actual. Projection is what we just did. We projected the income and the expenses for the coming year. That's like loading your shotgun full of shells and shooting it right in the air. Okay? I know the lender's projection because the bank examiners require in each loan file for the lender to have a projected cash flow, to have a copy of financial balance sheet ratios, and also possibly a copy of your previous year's income tax. My preference is an actual. That is after the fact of you spending the money, of you gaining the income, borrowing money or paying on debt to make it balance. So, therefore, let it be known that on page 2-17, it's a very simple paper pencil method of cash flows. The next step up for you is your accounting package to do this for you. And we will spend some time on one of these sessions talking about the different accounting methods and computerized record-keeping systems that are available. We work with what's called Farm Biz, and we will give you more detail on that in another session. Okay? Whether you use QuickBooks or Quicken or Farm Biz or PC Mars or whatever you use, that computerized record-keeping system should be able to spit you out an actual cash flow after you enter the income and the expenses for the month. So this, on session 2, page 17, is a paper copy of a cash flow where you have the expenses, the income, the balance then would work with your basic statement. If you have extra money during the month, it should get paid on your operating debt. If you need money in the month to pay your expenses, then you have to borrow it. And that's the way it flows. Does anybody have questions on cash flows or anything like that? Okay. Now comes the fun stuff. Back in our appendix, online people, you go to Appendix A. I'm going to spend some time talking about kind of a important subject matter the last few weeks, months. A1, what we call beef cow lease arrangements. A1 is a 60-40 lease. And what we're trying to determine is who's making the money on a beef cow lease arrangement. For years and years and 100 years, it's been a 60-40 split. The guy doing the work did a lot of work. So let's put the parameters together for this. Okay? Way back now. Okay, Appendix A, way in back. If you're doing this online, I would highly suggest that you print out this appendix, because there's some very detailed information here that can help you with your management decisions of your operation. If you're strictly a cash grain farmer, this beef cow lease stuff might be not pertinent to your operation. But if you look in the Aberdeen Green Sheets or the Farm Forum, you'll see a lot of people wanting to get into the beef cow business, leasing cows. Let's look at the parameters of what we're trying to illustrate, and then we'll have some discussion. Some known facts, and this is the 2011 beef calf crop, so this is pertinent on prices. Some known facts. The cow owner provides the bulls, so therefore the cow owner can improve his genetics or very inexpensive bulls and decrease the genetics of his herd. The cow life is 7 years on average. The cull value of the cow is $600. Well, I know it's higher than that, but some don't get culled and some die. So, the weaning calf, we plan on weaning a 550-pound calf at $1.50 a pound, and we plan on weaning 91 calves out of 100 cows. And this is all on a per cow basis. It's not on a per calf basis. And we all know every cow does not bring a calf home to be sold every year. The other illustration is $15 veterinary costs are paid by the cow owner. So, this is not a bunch of hogwash or what our president would say, Kentucky windage. Kentucky windage is kind of somebody blowing smoke. 60-40 lease. What we have then is an illustration if the cow owner, if he buys a $700 cow, an $800 cow, we used to top out at $1,000, but in the last years we $1,500. The value of that cow. Now, the calf income per cow, we got a 550-pound calf times $1.50 times 91%. We're going to realize in all these examples, $750 gross income per cow. And on a 60-40 lease, the owner of the cow gets 40%. The operator or the gentleman or lady doing the work gets 60%. Okay? Now this is for this 2011 calf that was fed in 11. Our numbers show that it costs $550 in cost to feed a cow a year. And as we said, this is not a bunch of Kentucky windage, because if you go into our annual report book, the last one that we have, on page 64, we're going to slide that in there. Total listed cost, $550 per cow. We're seeing that approach as we work with new 2011-12 stuff right at $600 a cow. Expense. Okay? So therefore, in our illustration, the operator of the cow is going to generate $450 of income, and it costs him $550. So he's losing $100 a cow. If he values his hay, grazing, everything at current prices, that's all pretty much solid. It does not depend upon the value of the cow. But if we put in here and look at the return on the investment for the cow owner, And there's an example of and all that greatness. But my friends, if we look at this $1,000, look at the $800 cow, because that, the verbiage relates to the explanation of the $800 cow. The cow owner is going to generate $300 of gross income. Now he has $29 of depreciation in that cow plus $15 of veterinary cost. So the owner of that cow is going to generate $256 per cow. And we divide that by the cost of the cow. He's going to generate 32% return on his money for an $800 cow. That's how the return is calculated. If it's a $1,000 cow, he's going to generate 22%. And if it's a $1,500 cow, according to these numbers and our estimations, he's going to generate 10.4% return on his money. Now, we can all sit and think about this, and we can moan and groan and whatever. These are the parameters that we are working with. Now, do you understand why in the farm magazines there's a lot of opportunities for young people to share cows and to feed them and calve them out for the investors? The real problem, we as young operators cannot borrow the money to buy a $1,500, $1,800 heifer and make it financially work. So we're strapped with the situation that we have labor, we have pasture, we have rough hay, and what are we going to do with it? Cash. So if we go to A2 then, which is page 2 of that appendix, we then look at a different lease arrangement. 70. And what does that do for us? Where we ask the operator gets 70% of the calf crop and the owner of the cow gets 30%. You rattle the numbers down, we're still losing $25 a cow as we feed that cow, but look at the return on the investment to the owner of the cow. And even at the worst scenario, the owner of the cow projected to generate 5.4% return on his money. And we're looking at these people that might have $100,000 or $200,000 of cash and they can't get 1% on a CD. So, this is a current issue going on. In Mitchell, we've got one of the 8 regional extension centers. And we got 2 really, really good beef extension specialists here. And as we had a meeting Thursday, they talked about 5 or 6 times in the last month. They've had many questions about lease, beef cow lease arrangements, and what's a fair lease arrangement. Their numbers, they ran it through calculator, computer, every doggone thing under the sun. 75-25 is a fair lease arrangement for the operator of the cow. That relates to this old cowboy. It's not in your 3-ring binder, but Harlan Hughes was a well-respected beef specialist within North Dakota State University, and this was in 2006. All his research and studies, 75-25. That remains percentage-wise today in a beef cow lease arrangement.
And that's supplying the bull, and that's the
owner of the cows provides the bulls, because therefore the genetics are what the owner of the cow wants. So the other way of doing this is, what can I do to make this profitable? Okay? The other way of doing that is I either got to cheapen up my feed source, I have to wean a heavier calf, I have to get a higher price for that calf, or I have to raise more than 91 calves out of 100 cows to make that more profitable. So those are the options, or else you got to change your lease arrangement. Well, again, who controls the assets is going to be the one that makes the financial arrangements. So therefore, the guy that owns the cows, he's probably not going to wiggle too much on the share arrangements. 60-40, 70-30, whatever. So, to put a summary on that, 75 is the common ground on beef cow share lease arrangements where the operator of the cow is getting paid for his labor, his feed, and his management of the cows. Yes, sir.
Is that calves and or like creep feed of calves, would that be shared in the same?
Yeah, the calf crop should be shared like the ownership and who gets who's, what, and where, I would say.
Maybe the creep feed would be part of the owner or the operators, because that would be supplement to the pasture, that would kind of depend on the situation on that.
Yeah, but he's also putting weight on the owner of the cow's calves too, so. In previous years, we talked about a flat cash rental arrangement, and that's about $150 a head, maybe 180 by now, where you cash rent the cows for 180 to 200 bucks a head. Run them all year, feed them, about 200 bucks would be. Or if you really want to get some intense work, you probably could calve out some cows for people and get paid so much per live calf, and then so much, like about $1.60 per day for feeding the cow, and have them for a 2 month time period. Some of that's going on.
That's pretty risky though, bringing in different cattle, you know, with scours and everything.
Well, possibility.
Oh, can I ask a question or not?
You bet.
On that, you know, somebody said, okay, I'll bring you the cows, but, you know, a first calf heifer, I'm putting a lot of growth in it, you know, it's not just maintenance and lactation, I'm putting in growth. You know, so his first calf heifer is gonna inflate in price when it comes to fourth heifer, you know. So I'm increasing, he's not just getting return on the calf, I'm also improving his asset up to a fourth heifer. So I'd be bringing nothing but fourth heifers and get them out of here when they're coming seventh heifers or something.
The question is, bringing in young cows, they're going to increase the weight, they're going to increase the value. Is the operator of the cow going to get paid for that? Probably the answer is no. Because again, the guy who controls the value of the asset controls the arrangements. So, it's a stickler. I've worked with this for over 20 years, and things haven't changed much in 20 years. For you as young operators, it's tough to get $1,500 borrowed money to buy a cow. So, the easy way to do is get into a lease arrangement where you can utilize your labor, your feeds, your pasture, and try and generate a cow without borrowing all that money. So the key to that is work on that lease arrangement. With high price feeds, input costs, we need a little fairer beef arrangement on that deal. So, okay. Also in this appendix, I want to share with you, there is coming from Iowa, would be pages A3 through about A11 or 12. Flexible cash lease arrangements on tillable ground. It's pages A through eight. Basically, it is by far the fairest way to rent crop ground. It takes into account the yield and the price. Now, if we work with a cash rental agreement with crop ground, obviously you pay cash and you hope the crop is good and the price is good and you hope you have crop insurance to cover any losses. If you're in a sharecropping arrangement where you as the operator get 2/3 of the crop and the owner of the ground gets a third of the crop, you're just renting the ground depending upon the yield. So the flexible lease arrangements are the fairest way, but because of high price with our grains, your potential to pay a real high cash rent on the ground is there, because it takes into account the yield and the price. Very simply, what you do is you put a floor in and a ceiling in. An example would be on a corn crop, maybe your floor would be the minimum cash rent would be $250 and the maximum $50, depending upon price and yield. You set the arrangement with the owner of the ground as far as how many dates you want to average the price. And that is on page A5. This example number 3, you determine how many dates, and it says there which elevator or which buyer of the grain. And in this example, they set the dates of April 1, June 1, October, November, December 1. So therefore, April and June, it's the October price. And then on the date of October, November, December, it's the cash price. And we average those. This is an example. And those arrangements can be set up between the owner of the ground and the operator. Government payments. The operator of the ground gets whatever government payments there are. It's handled legally rental arrangement. Flexible lease arrangements. They are the fairest to both parties. However, today with high crop prices, then the person operating the ground is going to be paying a little higher rental. There are examples of, you can look at those. They're fairly self-explanatory. Then on page A15 is some of the proudest work that we've done for the general public. And then we're going to do a short. If you're online, please print these pages out because they do have some value. This is work that Calvin Peets and I have done over the years, and we'll continue to do it with Chris Downs and Will Walter and Don Millicent. For the years 1993 to 2011, each of these crops, okay? If we go to A16, you're going to see then we got the year. The beginning inventory price is for balance sheet purposes, but that was what the price of that grain was at January 1 of each of those years. The average harvest price was the price around a 6-week time period around harvest. The average feed price is every Wednesday's price at the Mitchell elevator. And the ending would be the December 31 price. Down on the bottom then is the most recent 5, 10, and 15-year numbers of those columns. So of particular importance would be the corn numbers. If you're doing some budgeting, what's the feed price that you're going to charge to your livestock enterprises for corn? So if we go right down to and if we zing that up a bit, okay, you can utilize these numbers on the 5-year average. Basically, the harvest time price of $4.19 is an average if you're doing long-range planning and projecting. And the average feed price, 5-year period, 50 weeks out of the year. So that would be a 250-week average price of corn at the Mitchell elevator that they were paying for incoming grain. The 10-year average would be the average of the most recent 500 Wednesdays at the Mitchell elevator. With high grain prices today, it's not as accurate of illustration. If you really want to go back to some solid numbers, the 15-week average would be the average of the last 750 Wednesdays at the Mitchell elevator. Well, you can see what that number is, but if you want to go to each year, it's right there. So that is information that is for each of the grains that we work with, spring and winter wheat, corn, soybeans, alfalfa, and whatever it says. Any questions about that here with the Mitchell Group? You have that data. Sunflowers, sorghum, oats, corn, soybeans, spring wheat, winter wheat. Questions? Okay. This is this is part of the detailed information that you people view this online. You don't get to experience, but the people in Mitchell do. Okay. We're going to put a wrap on this session 2, the balance sheet and the financial cash flow statements. What we want you to do is, number 1, find your most recent 2037 and 2038 forms. Now, if you fill that out for the FSA loan officer, ask him for a copy, because you're going to need those 2 forms for session 3. Those people online, you need to find those same forms, but do not send them to me. When we get into session 3, we're going to do the financial ratios for our sample farm. You're going to need your individual Form 2037 and 2038 to calculate the financial ratios for your individual balance sheet and profit projection. And then after session 3, you'll do that calculation and bring them to me in Mitchell, or online after session 3 you can email them to us, or last resort, online people, you can send it in the mail. So the homework assignment for session 2, there is none to send back to us. But your homework assignment is to find the most recent Form 2037 or 2038. Or if you're viewing this and do not fill out those forms for FSA, you will need to find your most recent balance sheet that you provided for your lender and your most recent projected cash flows. Projected. So, the other homework assignment for you after this session 2, in your 3-ring binder that we have with the online people you need to go to pages, what are we talking here now? Session 3, right? Session 3, pages 1 through 10. Please review those. The financial ratio information, Session 3, page 1 through 10. Mitchell Group, you look that over before you come in 2 weeks. Because as we talk about it, it will make a lot more sense and it'll be a lot easier for you and things will flow so much easier if you preview and look that over. If you don't, you're going to struggle with it because it's a whole bunch of boring stuff about financial stuff that's going to be a whole lot of wet stuff that won't mean anything. So your time will be well worth it. Online people review that also before you look at Session 3 and before you view Session 3. Okay. You can stop the recording of this. Does anybody have any